Hi everyone, TJ Akawi from TJ's Financial Strategies, and this is our March 2026 quarterly update. Before we get started, just a quick reminder, this is general information only. It doesn't take into account your personal objectives, financial situation, or needs, and before acting on anything, you should consider whether it's appropriate to seek personal financial advice. If you've been watching the news lately, it can feel like every headline is designed to make you panic. And that's because a lot of the headlines are written for clicks and eyeballs. They're not for long-term investors. So let's slow things down and look at what's actually happened in the Australian share market since the war started, since the beginning of this year, and from a year ago. First, since the Iran war begun, the Australian share market has fallen by about 7 to 8%. It's a meaningful short-term move. It explains why things feel confronting when we see the headlines that we see right now. Since the start of the year, so from January through the end of March, the market's down around 3%. Again, this is uncomfortable, but it's not unusual. Third, if you look back to March 2025, so 1 year, the Australian share market is actually up above 8% for the year. An average year in the Australian share market has intra-year swings between 10 and 20% between the market highs and market lows for that year. So what we're seeing and what's happened so far, although it's uncomfortable, it is not unusual. In terms of bigger picture, what I've been watching in terms of the long-term themes that are shaping our world, we're seeing more fractures, more trade tensions, more regional conflict, and more countries focused on their own interests. And this is in line with our view of a less globalized world over the coming decades. What this does, it tends to go hand in hand with higher and more volatile inflation, and therefore, obviously, interest rates as well. Return per unit of risk really matters. So what this means is simply how much risk you need to take to achieve a level of return. So in today's higher inflation, higher interest rate environments, defensive investments are offering more meaningful returns than they have in many years. I'm seeing 6-month term deposits at the moment offering 5.15%. So this is what I'm talking about in terms of being adequately compensated for the risk that you're taking. What this means in practice, our overall philosophy and structures and strategies for clients remain exactly the same. First, cash buffers. So having enough cash to cover your short-term needs, which we usually look at between 12 to 24 months. That's about stability, flexibility, and peace of mind. Second, diversification, I think, is increasingly important. Because countries and markets aren't moving in sync, diversification matters now and going forward. Third, the risk per unit of return. Have a look at what we're being compensated for the risk we're taking and ensure that we're getting the most out of the risk that we are taking for our investments. If you have any questions, remember I'm here to help. When markets are like this, I'm available to chat. That's what I'm here for. Thanks for listening.